Hello, everyone. Welcome to today's session. Let's get underway here. We've got buy-sell ratio. I'm going to start out with this market conditions. I've got a little bit of data issue happening on direction alerts that we are working out. So we've got some blank charts on there, but those should be back up here shortly. But we'll jump there. There are kind of a couple workarounds here. When we're looking at buy-sell ratio and looking at breadth of the market currently, this is one of those indicators to be able to utilize. It's 1.27. And anything above 1 is a bullish bias. Anything above 1 is going to have the green line above the red line. Anything that is less than 1, when that buy-sell ratio gets down less than 1, then we have, or excuse me, rather like this, then we get the red above green, and that's bearish. That's bearish sentiment. That's bearish breadth, I should say. This is bullish breadth. And when they get really wide like this, that's typical where we start to see market reversals. This was the main market reversal back in October. It lasted a little while during this overall downtrend. Now we've been in this uptrend. This was a really the bulk of the overall uptrend, the breadth of that early uptrend. And we had a little bit of downside, and now we've kind of just been kind of cruising higher slowly without a lot of participation, but a lot of the big mega cap stocks and large cap stocks are participating, and so it's still moving the market overall. One other thing to look at is this index tab. When you're looking at the index scans and this buy-sell ratio here, then it gets broken down by indices. So you can see S&P 500 at 3.6 buy-sell ratio, meaning that you've got for every almost 4 buys, you have 1 sell. So here you have 200 on the upside, and you got 57 sells. So we still have a bulk of the S&P 500 in uptrends right here. That 148 is stocks that are in that hold range, and so they're not calculated in that buy-sell ratio. They just are kind of stuck in the middle. So sometimes this buy-sell ratio can jump quickly if you have a bunch of these holds that jump back up to this, and also it can drop if a bunch of those holds drop back down to sell right here. So we're seeing, really, still relatively flat and balanced as far as breadth is concerned, and really haven't seen any kind of real aggressive down day yet. And oops, I didn't want to go there. I wanted to go right here and look at S&P 500. So you can see just the last 4 days right here, really tight consolidation. But even back here, we had really tight consolidation for a length of time, really tight consolidation. Then you get that one big bar up, and then you get the one big bar up, and then you get the consolidation, then you get the one big bar up. That's kind of been the tone really for the bulk of this rally right here, but it's just, continually buying the dips. There's just a lot of interest in equities and the upside and the possibility of lower interest rates and AI creating productivity and efficiency in in companies and in the economy as a whole. So just still a lot of optimism right here. Now that can change quickly, as we know. We're certainly at the upper end of this range, but it's still, in terms of trend, we haven't seen like a parabolic move. And it's been relatively stable about that 45-degree angle on a stock chart. If I were to draw this and I were to draw, about a 45-degree angle looking like this, that's a sustainable trend on any stock, on any market, and S&P 500 is continuing to do that. Now, a couple things to be watching for. So the overall bias is still bullish to the upside. We've got buy-sell ratio that's 1.27. That's still bullish. We've got buy-sell ratio on the indexes, which is still bullish, and we've got an uptrend and support, lots of support at lots of different levels. There's really all the way back down. So really anywhere between, here and here on S&P 500 is still an acceptable range for drawdown or retracement. But that's going to create some volatility. That's going to freak some people out. If we were to break all of those levels and continue to see resistance, it can happen quickly, but typically doesn't. Typically happens it always starts with 1 day, and that 1 day has to turn into 2 days. And so here we had 1 day, here we had 1 day, we kind of had 1 day. We haven't seen anything, really settle into 2 down days, 2 consecutive aggressive down days. So if we see a large black bar or down bar, now when you're seeing the black bars like this, all that is, if I were to change the signal back here from signals to candlesticks, it just removes the trend signal from the chart and just gives you the, the traditional up and down. In this case, they're gray. Some charting tools are green and red. In this case, it's gray or white to the upside. That just means it's a bullish day. So if you see a candlestick that's white in this case, and or I'll change back to the other viewpoint. But if it's white or green or gray in this case, like this one here, that means that the open was here and the close was here. So it opened and it traded higher all day. So it's a positive day. It's an up day. It closed higher than it closed higher than the open. Okay, the open was here. Here was the close. If you get a red day or a down day, obviously it's the exact opposite. If you have a bar like this, if you have a bar like this, then you're getting a down day where it opens here, trades lower, and then closes here. So it's closing lower than where it opened. That's going to create a red bar. If it closes higher than where it opened, that's going to create, in this case, a white bar. So when they're black and you're in the signal setting, it just lets you show that it's a down day inside of an uptrend. So it's black, but it's still green. You can barely see it, but the outside of that is still green. So you know that, okay, we had a down day. It was a red day on the overall chart patterns here, and you can see a lot of them, but the overall trend, the green trend is still in place here. Okay, so if you see those black candlesticks, it just is letting you know that it was a down day inside of the uptrend or the downtrend. You're getting those there as well. I can also remove the volume. Sometimes that volume gets in the way of the price information. If you want to see that a little differently, you can just check that box and get rid of that volume as well. Gives you a little bit clearer picture. So you're seeing those black bars and the yellow, they're going to happen in any of the uptrends and any of the hold consolidative trends, and then also the downtrends as well. If you were ever wondering what the heck are those things, those chart colors, that's what those black candlesticks represent as well. So S&P 500, let's jump over to NASDAQ as well. NASDAQ, really similar type price pattern. Add that volume back where you've got this, this is actually a pretty bullish looking pattern when you have a base here and then you get a move higher and then it retests. If it'll hold that retrace or retest and then continue to march higher, there's a good chance for that. It's now moved back out of extreme, back into that momentum zone or that bullish zone. And that's also what we want to see. If we're waiting, sometimes we'll get stocks that, let's see if we can find one. And I'll show you an example of that here. Let's see if we've got anything that have moved higher up into the extreme. So something like this, where you have a stock that's moved up to the extreme, okay, we'll typically see that they can stay extreme and in an uptrend for a length of time. But we also know, so we don't necessarily want to sell just because it's extreme. What we want to use the extreme for mostly is entry. Okay, although we still can enter into an uptrend, but it will move into an extreme zone, but it will move back to this buy zone typically, and then allow for a little bit better setup, maybe a little bit better retracement. This one's not too bad right here, actually, because you've got 2 days of pulling back, even though it's still extreme. And it's a really strong uptrend on this stock as well. So watching for those extremes, sometimes if you're like, I'm not gonna buy into anything extreme yet, I'm just gonna wait for a retracement, let it pull back into that buy zone, and that can create a little bit better range for more upside. Some of these stocks that have just gone completely parabolic, ROOT is one in the last month that has had just a really big uptrend, and you can see what can happen. A big down day, but there were buyers that just came stepping back in there as well. Anyway, that's kind of a side note in terms of looking at the black candlesticks and then also the extreme area. The extreme, again, doesn't necessarily mean to sell, but what it may mean is you may get a better opportunity on a pullback. And if you see that and understand that can continue to move to that upside, now you know. Let's see. Let's jump over. So the overall market breadth, market conditions. One of the other factors is bonds. Yeah, there we go. This is the update that we're working on. We've got a couple things that are still showing up like this. And we have that resolved, but we're continuing to fix that today. So we'll skip over that chart, but bond prices have kind of pulled back, not a whole lot from the last couple of days. The morning update this morning talked about that as well, but that's going to be an issue. That's going to be an issue of We want to see bonds continually move higher. We want to see, that means interest rates are moving lower. If we look at commodities right here, really one of the other factors we're watching is oil. Oil finding some support right here and working on this overall uptrend. Now I say it may be relevant just because we're talking about headwinds, interest rates, oil prices increasing. Those are headwinds for economic growth and companies as a whole. If you're paying more money for gas and oil and petroleum and anything to do with that, it's going to cost you more. It's going to, that's going to affect business if that oil price really gets moving here, which is always a possibility. And then the other real big commodity that we've been paying attention to is gold. Keep an eye on that. Still working that overall uptrend, working on a retracement, and now this consolidate or this sideways pattern. We'll see. We're back down to this range now. Momentum is slowed from this initial pop to this consolidative sideways pattern here that we should continue to see gold moving to the upside. I wanted to follow up and add on to last week's class and talking about entry a little bit and talking about risk management and position size, as that tends to be the biggest problem in my opinion for most traders. Is they'll find a stock and they'll say, okay, let's find a chart pattern like BLND and say, okay, it's been volatile, obviously, lots of volatility here, but it's now in this upper momentum zone. You've got support off that 236, a bounce bottoming tail bar. Okay, now there's several different methodologies you can utilize in TradersPro. The one that I prefer and use the most is this pattern here, where we're focused on a 6-month time frame. We're focused on an uptrending stock. It's got to be a high ranked stock in 95, even 90 or higher, really. And then ideally you get some additional volume confirmation moving higher, and it's bouncing at the 236 and it's in the momentum zone. So 6 months, 95 or higher, increasing volume, bounce off of support, and it's in the momentum zone. That's primarily most of this time the setup. If you're looking for setups, and those new buys are almost always, well, not always, but almost always these kind of setups. Sometimes you don't have volume, sometimes it's a breakout higher, sometimes it's maybe deeper in the pattern, a little bit lower the chart pattern. But if I pull up a chart and it looks like this, where it's at the upper end of the chart pattern, okay, it's sitting right up here on the chart if I'm looking at, because really that's all that matters. Yes, I want to know where it came from. I want to know if it came from here or if it came from here and starting to move down. But once it's moving that direction, I already know it's got strength because it's going to be a 90 or higher, 95 or higher, 98 or higher. I know it's going to be strong because that's what the rank is telling me. It's already factoring in stocks moving higher. That's why the screens are so valuable, because it sorts them by rank. So it's already pulling in the highest ranked stocks. So I don't have to look too far. I know that anything up in this upper range are going to be stocks that are moving higher. They're moving this direction. Okay, they're moving this way, and that's what I want. I want that path of least resistance. The path of least resistance on momentum stocks is higher, because that's the power of the direction. This is now resistance. This is now resistance. This is now resistance. So the path of least resistance is to the upside. Just like a stock that has gotten beat up. Let's see if we can find. Let's see if we can find something here. These weaklings are sometimes. Let's even go way down in some of these ranks and see if we can find anything here. Vail Resorts. See the 1-year time frame. So it's not a great looking chart pattern, but here's an example of a stock that is in a downtrend. Okay, and there's resistance, resistance, resistance. Okay, anytime that the stock's going to try and move up, it's going to hit resistance. If it breaks that, it's going to hit resistance. If it breaks that, it's going to hit resistance. If it does that, and it's broken through this resistance, now it's on the upper half of this chart, then I might be interested. But as of right now, if it's way down here, I don't care what it's doing. It's not the trade I'm interested in. That is momentum. Now, that might be a trade for a value investor or a contrarian investor. Contrarian investors are looking for stocks that they've gotten beat up and they're clear down here. Nobody's interested, and there may be good value, and they may ultimately head higher. But that's that, and you can utilize that methodology here as well. But primarily, we're focused on these kind of stocks: new buys, uptrends, and looking something like this on a 6-month time frame. Okay, so here's an example of a stock that is in that uptrend, potentially starting to weaken right here. Okay, so now we also have kind of that line in the sand where we can say, okay, well, it's just weakening here enough, a little bit. If there were an entry or a buy here, this wouldn't have been, ideally I wouldn't have entered into a trade like this. Why? Because the candlestick is not solid confirmation to the upside. Ideally, I want a solid green bar to the upside. So again, as you're scrolling through and looking and having to make some decisions on, well, what stock should I be buying, there are some additional formats to be able to be looking for as well. Volume, confirmation bar is up. Let's see if we can find some additional examples here as well. Carvana is a good example back here. In fact, we bought this into the portfolio on this bar right here. Increasing volume, upper momentum, good solid confirmation bar. Solid confirmation meaning it opened, it traded higher, and it didn't look back. It ultimately closed at the high of that day as well. So if you get a bar that looks like this and it's green to the upside or gray to the upside, if we were using that other candlestick pattern, that's what I want to see. That's the best candlestick that we can look for. And if you can get it on a breakout location here, something like this, those are very telling bars. And so if you get one of those in those momentum zones, they definitely add more value. Now, that being said, momentum stocks, especially these momentum stocks where they're biotech or technology or AI or, there's flat out speculation, you get volatility. So you hang onto your hats. You're going to get some wild rides on some of these stocks. Here's a case right here as well, where some buying, some selling, lots happening here. Pardon me. All right, let's find a good example and then let's walk through that entry process here. And CLSK is an interesting one right here too. These are Bitcoin miners. We got stopped out of this one. We made some money, not on this one, but on a couple of others during this run up. Made another attempt to get in, got stopped out of it, did not re-enter here, but re-entered into Coinbase instead of miners. And Coinbase is continuing to do well. But let's look at, let's see if we can find an actual new buy that's got decent entry. And scroll through some of these. Okay, here's a good example, or at least here's an example. So let's avoid today's bar. Let's assume that we had run the scan. It's an end of day system, so all the scans are updated at the end of the evening once the market's closed. About 6:30 Eastern time, everything is updated. And then you can go in and analyze. And typically what we'll do is we'll go in the next morning, or you can do it that night and enter your trade as a good till cancel order. And then it's set up. It's set up with your broker and you're good to go for that entry. Now for here, what I want to do is I want to utilize what I call the wheel strategy. The wheel strategy is adding into a stock or multiple stocks over a certain period of time and with a certain cadence, meaning I do it once a week or I do it once every trading day, which is primarily the methodology that I like to focus on, is entering into a stock every day. Now we're using a certain portfolio allocation. We're not buying, 10 or 15 or 20% of the entire portfolio. We're doing 2 to 2.5%. So we're doing relatively smaller position sizes, but a lot of them. Okay, we get compounding daily. We get diversification across trades, and it allows us to take on multiple trades at one time. Yes, let's say you have a 2.5% stock allocation to a stock and it goes up 100%. Well, your gain is 2.5% of your portfolio size as well, with 100% increase on a stock. So sometimes people are like, I want more, I want it now, I want to take a bigger risk so that I can get bigger reward. Well, okay, that's fine, if that's the choice. In this case, as long as it's a method, as long as it's a systematic approach, so that you're doing the same thing over and over again, because you're going to have losses and you're going to have stop outs and you're going to have big winners. You're going to have duds that maybe sit there, or maybe they make 4, 5, 6, 7%. Hey, what are you going to do? What are you going to do when they don't do anything? What are you going to do when it does move? What are you going to do when it doesn't move? Okay, that's essentially a trading plan. The plan is, what are you going to do in circumstances? And you have to have that in advance. If you don't, you'll continually struggle, because you'll be jumping back and forth from system to system, method to method. Well, I'm going to buy this because I heard on the news that this, that, and the other, or I heard so-and-so say this, or I heard so-and-so invest in this, or some insider bought this or that. Like, if you're jumping around on entry based on a lot of different reasons, then that just creates inconsistency. So if you're adding in the same way and the same method and the same, with the same rationale and the same reasoning, then it's about risk management. Okay? It's about managing the size of the positions. If your entry, stop, and targeting are all established. Now, let's say that we wanted to buy this stock. I simply need to know two things. I need to know, number one, how big of a position can I take? It's a $182 stock. What should I buy? Should I buy 1,000? Should I buy 500? Should I buy 2,000? Should I buy 10,000? Should I buy one share? Okay, so in order to remedy that, you want to have a fixed process. So I typically will use 2.5% as the starting point. So if I'm buying $183 stock and it's not going to allow me very many shares, let's start with 10 and see where that's at. That puts me with my portfolio at risk at 1.76. 1.76 is $1,800 of a $100,000 portfolio. I could go slightly more than that. Let's go 12 shares. That's 2.11. Let's go 11 shares and see. That's right around that 2%. Right now, I'm doing right around 2%, just because market conditions are a little bit, frothy, a little bit lofty, and I don't want to have too big of a position size. If it's a little earlier in the trend, maybe we might go a little higher, go 2.5, go 14 shares. Okay, so this is what you're watching when you're adding in position size, the number of shares, the portfolio at risk. This is data point number one. Okay, this is what you want to know. Why? Because that tells you worst case scenario. If this thing fell off a table and went to zero, my risk is 2,500. Okay, the chances of it dropping to zero, the chances of a stock dropping to zero are really, really low, at least overnight or within a week or even 2 weeks or even 2 years, right? That if a stock starts to drop and move lower and ultimately goes to zero, it's a failing company, and the shares are going to be sold well before it drops to zero. Now, if it's a biotech or something, or maybe there's litigation, or maybe there's I don't know, lots of unknown reasons, and that reason pops out, then those shares can certainly fall overnight by 50% or something catastrophic, but not the entire amount. So this is worst case scenario. Now, we don't want that, obviously. We want to have a stop loss in place. So I want to be able to, number one, I want to have a stop loss that's below, as much as possible, the prior base. Okay, so the prior base is essentially this corrective or counter trending move. Okay, this entire chop right here, if I get a bar that gives me enough of a confirmation to take a trade on it, I want to try and set the stop down below all that. That gives, and again, in theory, it should. These are all buyers and sellers, but it's not aggressively selling because it's not moving lower. So it's kind of a tug of war. Well, once buyers start to show up and start to take over, well, now I know that this level, if it trades back below this level, I need to make sure I'm out of that trade, because that's a significant support area, and there's something up. There's something wrong with that trend. It's starting to fail. I don't want to participate at that point. So let's set our stop loss. Let's look, and a lot of times I'll use that 236 number. That's the Fibonacci tool where you're grabbing. It's this box right here. If you can see that, once I get rid of this form, I'll pull this up again. But it automatically connects your swing low and swing high point on that time frame, and then you can use a stop here at 175. Let's say I did a 175 stop. Okay, $175 stop loss, and let's look to see what that looks like. So a stop price here, 175, that creates portfolio at risk of 1.11 of 1%. That's $116 at risk. Why is that so small? It's because this stop loss is not very wide. From here to here, 182 to 75 is only 4.5%. Okay, so in this case, this actually would be not a bad reward to risk type trade. I'm risking $116. If it drops below 75, then I'm going to get stopped out and I'm going to lose $116 in return for the possibility that it gains a whole lot more than that. Right? Momentum trades, we don't cut them off at a target. We just let them run as long as they can, as long as they do. And then ideally, we'll just adjust that trailing stop as it's moving higher. Once it gets up into that area, then we'll typically rebalance it, sell off some of the winner, and move that money back to cash. So this is your initial risk profile. This should be done on every single trade you do. You want to know your risk for the portfolio, and you want to know the risk for your stop out as well. And then pull the trigger and go, right? That's all you can do. You can't do anything more from that point. You can't control the stock. You can't control the market. You can't do anything. Okay, there's absolutely nothing more we can do other than decide how we're going to manage our risk and then how we're going to manage that trade going forward. Obviously, once it starts to move and we have some gains or things that we can do to sell. That's just a quick overview of one of the buying methodologies or process in terms of risk management. Risk management meaning how much money could I lose? Okay. And if you think in terms of, I think most traders think the opposite way. I think most professional, really good traders always focus on risk first, okay? Because that's the only thing they can control is the risk. The outcome is uncertain. The outcome is out of their hands. Yes, they might think that, I could think that this stock is going up and I might have every reason in the world why it should, but it might not, okay? So how much you know about a company or what you think might happen about a company, it's 100% irrelevant because it's going to do what it's going to do. Yes, it probably will go that direction you're anticipating. If it's a very profitable company and they're making a lot of money and it's moving higher and it's in a sector that is also hot and profitable, then the probabilities of it continuing higher from here are very high. Okay, so but making sure those risk parameters are in place, and that's a couple ways to start out. Obviously, you can use the portfolio builder. Then once you have that form built out and you've added it in, then you can track and have just a little bit different visual representation. You'll notice these pie pieces start to get a little bit bigger. And as those pie pieces, like on CLS right now, that's probably got the most gains, 3,700 still, it's up 48%. So the gains on that are $1,200. If I wanted at this point, even though the stock hasn't doubled, but I have gains that I want to move to cash, then here of that 3,700, I could take 1,200 of that where it's showing you that gain loss and sell just the 1,200. That rebalances that piece of this pie back to a little bit smaller sliver. So I'm reducing my risk of the exposure to that one stock, and I'm moving that money back into my cash pool. Okay, and this cash pool is really what we're managing as far as risk and how many holdings do we have, what are we selling, and moving that money back to cash. And right now we're about 50, a little more than 50% in cash, just because that's just how it works. When we don't get stopped out of trades and we have a lot of trades working and winning, then the allocation can increase significantly and the number of holdings can increase as well. But right now, it's just kind of it's a natural portfolio evolution of either getting stopped out of losers. That's going to naturally reduce the number of holdings as well. And then also selling into either selling your losers, like for example, we've got a couple that are starting, that haven't been stopped out, but they're showing some weakness. They're relatively new trades as well, and sometimes that'll happen. They may bounce up and down around a little bit here, and so that's normal. But if I were looking to say, okay, I'm not comfortable with my holdings right now, and I've got to start selling something, where do I start? I'll start with the losers first. Next, I'll go to the winners and say, all right, what are my winners doing? ALPN, we don't have that big of a position because we've done this already. We've already sold some of the gains, and now these are just remaining shares. Okay, these are runner shares or house shares or whatever you want to call them. It's just we still own shares because we have been continually sold into the strength, but we don't want to sell everything into strength. We use the stop loss for the remaining stop out. But I could say I've got too many holdings and I'm not comfortable with how many holdings I have. Well, where should I start? So if you're starting with some of these winners and say, okay, I'm going to take a little money off the table here, but I don't want to sell everything in a winner because this winner could really launch and take off. I don't want to be left behind on some of these winners as well. So lots. That's a big conversation, but really it's a very basic process to be able to go over and analyze this methodology: momentum trading, portfolio building, and then utilizing the percentage allocation for your holdings and your stop loss, and then using rebalancing for your gains. As you all know, this is what I do every morning in the Discord channel in the Muscle Wheel portfolio. This is the Muscle Wheel portfolio. So if you're interested in participating in that each morning, where we give these individual stock trades and the stop loss, and then management as well. Which ones are we selling today and why? How are we adjusting the stop losses and why? How are we updating? How are we taking profits and why? All those things are, we cover those in a lot of detail every single morning in that Discord room. Again, if you're not familiar with Discord, Discord is just a platform where, let's see if I can pull it in here. It's just a place where you can have different communication. So for example, the Muscle Wheel portfolio, I'll give the chart pattern, I'll give what we're adding, the symbol, the limit order, the stop loss, and then also any portfolio adjustments here. So for example, yesterday, we're selling at NGL, we're selling CLBT, we're selling 2 shares of SCMI, we were stopped out of FATE, okay? So portfolio management along the way, and then also each of the new trades. This is every morning we'll add into a new trade. Here's that Carvana trade. We got into Carvana and where was it here? There's Carvana and then Coinbase right here as well. But very systematic process. Again, that's what I prefer. I like a systematic process. We'll manage the stop loss. We'll manage everything from there. Again, I want to give you lots of value in these recordings, in the presentations as well. You don't have to join that Discord room if you don't want to, but essentially that's what we're doing. It allows you to learn a little bit quicker also, because you go 2 or 3 weeks in this, you're going to have a pretty good idea of how you can implement it. And there are changes that you can make. You don't have to follow my picks. You can create your own scan and follow your own picks, but you're using the wheel methodology, which is adding into a trade each day and managing that with a stop loss and then a targeting system as well. So that'll do it for today's update, and appreciate everyone's time and effort today. We'll see you next time. Thanks a lot. Bye now.